Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories.
Hello, and welcome back to the Joss Brown Podcast. I'm Philip Saunders.
I'm Dan Joss.
And today we're going to be talking about Q4 2024 and also the rest of 2024 and how the markets did.
Yeah, we've never done this before.
Yeah, should be fun. So there was a mix of good and bad and some in the middle, and so that's just the markets in general. So let's start with U.S. stocks. We've got here the total U.S. stock market, so the Wilshire 5,000, and Q4 was 2.63% up, and then over the year it was 23.76%. So it did well.
Arguably, fourth quarter was weak. Only slightly positive.
Yes, compared to the rest of the year.
And actually,
absolutely.
in the whole, the quarter was slightly positive, but I think October and November were positive, and December took away most of the gains of the quarter.
That's right. Yeah.
So good.
Yeah, so total stock market up, and then we split that
Which is interesting.
Yeah.
Because the year before, the markets were up and down, and they were, in the end of October, they were where they were at the beginning of the year. And I think we had a great November and December.
That's right.
And so this December
on the year,
knocked out a quarter's worth of gain almost, but both years ended up over,
this year
over
every quarter was up, wasn't it? There was no negative quarter. Yeah. So this year every quarter did well.
But 2.5% gain in the corner for the whole market, and almost 24% on the year.
Mm-hmm.
Most of the gain in the year was the first three quarters. By far.
Yep.
Yeah,
absolutely. And then we break that into large cap and mid and small cap. Large cap was the winner there. If you take the Wilshire US 2500 large cap, over the year that was 23.94, so a very similar number.
Mm-hmm.
The S&P, everyone knows that one, 23.31. And then if you take mid cap, the Russell mid cap index 15.3, and then the Russell small cap index 11.5 over the year.
So large was where it was, and we've known that the S&P 500 has over 90% correlation to the total market.
Yeah,
and it showed it again this year.
Yeah, and I think if you break that up, I didn't look into this too deeply, but the headlines is technology, AI, those big companies, NVIDIA.
Which we know did
7.
great for the first part of the year and didn't do much the second half of the year.
Yeah.
So that shows what happened here.
Yeah, absolutely.
Good. And the same is true for valuations. If you look at price-earnings ratios, large cap, or the market as a whole, is over 20. But mid and small cap are in their teens. So they're more reasonably valued. They didn't go up as much, and so they're not as expensive.
Yeah, and so just comparatively, they're a little bit cheaper than the large cap stocks. Is there a certain PE that you would say that you're
I just
targeting?
Look at long-term historical averages.
Just compare them.
I think the last several years, the average was 18, and now it's above 20. So you could say arguably
averages are up. Yeah.
The cost of the stocks are higher than average, and then there may be some correlation to, or the chance of the market going down is higher if you revert to the mean periodically.
Yeah.
So this is why some economists would say the markets are overheated. Well,
sure.
But we know also that after a high, chances are you'll have another high. And I think the statistics that Dimensional puts out says after a market high, the average next 12 months of performance is positive 10%. So we had 2 great years of 20%. We may go up another 10%.
Absolutely. Yep. We'll see. We'll keep you posted. Okay. So does this mean we should put all of our money in large cap?
No.
Yeah, I agree. Let's do some of
what are we doing with our portfolios
some of
right
each,
now?
Yeah.
No, I mean because of this performance, stocks are up 20+%. Large cap stocks are up 20+%. Mid and small are up half of that, or 2/3 of that. International is essentially flat on the year, up maybe 5% in emerging markets.
Yeah.
Real estate was up 8%, but bonds were flat on the year.
Pretty much flat.
Slightly single-digit positive.
Yep.
And so when we do a traditional rebalance, if something's up over 20%, it's now more than it should be compared to its target. So we would be actually trimming stock, adding to fixed income.
Exactly.
Adding to
and maybe a little international as well,
Yep.
Absolutely. So the foreign was pretty much flat for the year, slightly positive, and then emerging markets about 5% in 2024. So.
And the same as small and mid to large, international is reasonably valued.
Okay.
It's closer to its historical averages in terms of price-earnings ratio.
So we'd say more fairly valued, Okay, and then bonds flat for the year pretty much. There were some differences in terms of if you took the long bonds or short bonds. In terms of the yield curve, there have been some rate cuts, and so the yield curve has flattened just a tad. So now things are looking relatively similar, I would say. So the 30-year yield currently is just over 4.5. 10-year also just over 4.5. 3-month is 4.3. And then the munis is relatively flat as well. The 5-year is at 2.9, and the 1-year is at 2.97. So pretty close there. And then global bonds. I had global bonds down here as well. They did well last year comparatively to the rest of the bond market, up 3.4% last year. So bonds stayed pretty much stable, which is their job in the portfolio.
Yep.
Stability.
Certainly less volatile than the markets.
Yep.
Both in good stock and bad stock markets, bonds should be right in the middle.
Absolutely. Yeah. And so
and we collect the income along the way.
Yeah, and there's income.
And
exactly.
So now we're getting 4.5%.
It's great. Yeah. A lot more than we used to, even on cash, All I ever knew on cash was that, it was 0.01%, and now finally we're getting some interest on cash. So that's pretty cool too.
4% is good.
Yeah. Inflation has now slowed, which is nice. The number for November was 3.3%, so that's great. Okay, and then any predictions for next year, this year?
Well, we could talk a little bit about inflation.
Yeah.
Is the rate of inflation has declined a little bit, but inflation is cumulative. So we know things like housing and insurance and cars, they're all more expensive because we have had on average 5% a year for the last 4 years. So things are much more expensive than they were a few years ago.
Yeah.
So inflation is still going up. It's just going up more slowly.
Exactly. Yeah, it's not deflation. That's right. Absolutely. Any predictions for this year?
Nope.
2025. Just stay invested.
Keep cash for the near-term needs.
Yep.
Keep an emergency fund for unexpected expenses.
Spend less than you earn.
Earn more than you spend.
Or earn more than you spend. There you go. So we would just say to our clients and to others, make a plan and stick with it.
We're rebalancing the portfolio.
Your goals. Rebalance.
For our retirees that are pulling out of their portfolio to live on, we're trimming equity this year.
Yep.
For pre-retirees that are adding to their retirement accounts or their trust accounts, we're adding to fixed income.
Yep.
Because it gets closer to a target portfolio.
The target. Yeah. Yeah, I think a lot of people are tempted, and when they see market highs and see these high returns, it's like, oh, well, it can't happen forever, so let's change things and let's go to cash, or let's go to bonds. And we would just say, you don't know what the future's going to hold. The market may continue to go up.
Sure.
Just as
Well, what I've heard as an opportunity is you do a Roth conversion when markets are down.
yeah,
But equities, even just December, 3%? It's not like 20% discount. It's 3 or 4%, even 5%. It's not a significant thing. So we'd say stay on your strategy of Roth conversions, and maybe you do a big one if the markets drop 20%, but that hasn't happened. Hasn't happened in many months, and we've
knock on.
rarely seen a 5% decline in a day, and we were seeing that years ago.
Yeah.
So stick to the plan.
Stick to the plan.
Live your life.
That's right.
Have a good one.
Yep. Don't worry about the market. Stay invested. Okay. Well, thanks for listening, and we'll see you next time on the Josh Brown Podcast.
Thank you for tuning in to today's episode of the Josh Brown Podcast. If you'd like to see more episodes, visit our website at joshbrown.com.